The gentleman from Illinois, Mr. Casten, who is also the Vice Chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Pro Tem Powell. I'm always struck that there's a real risk of hubris for those of us in our line of work, at least up here. If we get to write laws, sometimes we conclude that means we can write the laws of physics as well, which is dangerous. And I am troubled by some of the questioning of my colleagues and some of the debates around confirmation of your colleagues around climate change. The IPCC report that came out last week said climate change effects are outpacing our ability to adapt. We're seeing communities that sort of simultaneously have droughts, floods, and fires, and money is moving in surprising ways. Personally, I've seen stories just in the last month of one coastal community where the roads are being washed out that haven't yet paid off the bonds that were used to pay for the road, and they don't know how to reconnect those communities. Another community on the coast where the mayor is sitting there realizing that one neighborhood he can afford to build a seawall, and in another neighborhood it's cheaper to relocate people, and dealing with the political fallout of that decision. We have massive political risks that are coming, and we know they are coming because the laws of physics do not care how we vote. And I'm concerned by your response to Mr. Posey when you said that I think you said we've not even done the scenarios yet, excuse me, on the climate change. And I understand these are complicated, but if those scenarios haven't been done, I want to start, if we don't deal with the financial fallout, the political fallout's going to be far worse. And so I just want to start with a very specific question. NOAA and NASA came out with a report, I think last week or 2 weeks ago, saying that Florida is looking at 12 inches of sea level rise in the next 10 to 20 years and 18 inches by 2050. That means that there are whole communities in Florida where there's going to be complete property loss before a 30-year mortgage is repaid that was issued today. Are Fannie and Freddie changing their lending standards in response to those risks in those communities in Florida and elsewhere that are now within 30 years of being unable to repay those notes?
I don't know.
I asked the question there because in the CFTC report, Managing Climate Risk in the Financial Sector, came out about 2 years ago. They noted that the higher an area risk for coastal flooding, the more likely the commercial banks are to be offloading their risks onto Fannie and Freddie. And so if the sophisticated players in the system are seeing this risk and we are at a federal level are backstopping, how are we isolating our federal balance sheet from that risk exposure?
I think that's a very likely outcome, actually. I think as private lenders will move away from that, and will the government force people to move away from the coast, or will they wind up government, that's us, wind up picking up the tab? More likely the latter, it seems to me.
So moving away from the offloading risk onto the taxpayer, back when I was in the energy industry, one of the tells that we had that we knew there was a downturn coming in energy markets was when the big banks started creating Special Opportunity Fund 5. And we all knew that was code for taking your Dodd-Frank compliance debt capital, moving it into an equity pool, and selling it off to the least sophisticated people in the equity space. We all know, anybody who spent time in the banking industry has seen that game. To what degree does the Fed or the Treasury have the ability to monitor where the sophisticated folks who are seeing this coming are shifting the risk off to the less sophisticated folks in the private sector?
There's a lot of thinking going on about this. I'd have to think about that. But there's a lot of thinking about what will happen over longer periods of time in coastal areas and things like that. I can look into that for you.
Well, and it's not just coastal, right? I mean, it's California fire risk. Do you rebuild that house where the fire is, and who's holding the paper, if it burns the second time before it's paid off? It's drought risk in communities, running away, the capital movements. And to be clear, we are going to create so much wealth in the transition to a clean economy that I think we can find more winners than losers if we're smart about this. But there's this huge capital flight, and the nervousness I get is, as I said, partly that we're shifting risk onto the public sector, and partly that if we don't have a real good understanding of what the capital structure looks like in these communities, we're not seeing it. As you know, Senator Schatz and I have introduced this bill to push and encourage you and your colleagues to do these climate, whatever we're talking about, scenario analyses. But we know the sophisticated people are going to offload the risk. And as the IPCC report said, the effects are outpacing our ability to adapt, and we need to get ahead of this much quicker.
I would want you to know we are working on the scenarios. It's just, you know, it's an active effort on our part.
Well, let us know how we can help you. Make sure you have the resources to move a lot quicker. Thank you, and I yield back.